Something was said this week that the mainstream financial media completely ignored. And I want to start right there, because if you heard it and understood what it actually means, you already know we're not talking about a trade. We're talking about a structural shift that has been years in the making. The CEO of Evernorth just made a public statement about XRP, not a blogger, not a Twitter influencer, not a crypto podcast host, a CEO. And what he said cuts right through every debate this community has been having for years. He said XRP was built for finance, not built for speculation, not built to compete with Bitcoin for the digital gold label, built for finance. Now, why does that matter right now, in this specific moment? Because while the retail crowd is still asking when moon, the architects of the next financial system are quietly lining up every piece they need. And once you see what those pieces look like together, you're going to understand why XRP's current price isn't a disappointment. It's a gift. But before I get into that, there's something most analysts refuse to say out loud that you need to understand first. Welcome back. This channel exists for one reason: to cut through the noise and give you the structural analysis that the mainstream crowd refuses to do. No hype, no moonboy predictions, just data, patterns, and the honest interpretation of what institutions are actually doing versus what they're saying publicly. If that's the kind of deep analysis you've been looking for, you already know what to do. Let's start with the hard truth. Most people in this space are still asking the wrong question. They're asking, will XRP go up? That is a retail question. The institutional question, the one being asked in boardrooms right now, is this: which network can move the world's money at scale, legally, efficiently, and without breaking under the weight of global finance? And that question has exactly one engineering answer. Here's what most people don't understand about the digital gold narrative. That label was given to Bitcoin because Bitcoin needed a story. It needed a reason for retail investors to hold it. Store of value, hedge against inflation. Digital gold. It worked. It worked spectacularly. And that's not an insult. That's just how markets get built. You give an asset a narrative, and capital follows the narrative. But here's the problem. Technology doesn't pause for narratives. The Evernorth CEO, Burla, said it directly. He said blockchain networks are increasingly becoming the infrastructure layer for the next generation of finance. And he specifically pointed to XRP's expanding utility across lending, payments, and on-chain finance. That's not hype. That's a CEO of a major financial company publicly describing a functional role for XRP inside the financial system. Think about what that means. Digital gold is passive. You hold it. You hope it appreciates. Digital infrastructure is active. It gets used. Every single transaction that flows through it creates demand for the token. Every bank, every payment provider, every tokenized asset that moves across the XRP ledger, that is structural, recurring, non-speculative demand. And when you understand the difference between a narrative and a design requirement, the math becomes impossible to ignore. Here's the math that the retail crowd ignores. Right now, there is approximately $27 trillion sitting locked inside Nostro and Vostro accounts around the world. These are pre-funded liquidity pools that banks are forced to maintain to facilitate cross-border payments. Dead capital, earning nothing, locked in place because the current system has no better solution. On top of that, you have $150 trillion in annual cross-border payments flowing through a network, SWIFT, that by their own admission, 80% of a transaction's total journey time is spent in the last mile, not in the SWIFT network itself. In the gap between the payment arriving at the beneficiary bank and actually being credited to the end account. 80% of the delay happens after SWIFT does its job. That is the problem XRP was engineered to solve, not as a speculation vehicle, as a bridge asset that eliminates the need for pre-funded liquidity accounts entirely. Now here's where the math gets serious. Fixed supply, 100 billion XRP total, roughly 55 to 57 billion in circulation. If you want to move even a fraction of that $27 trillion in locked Nostro capital through XRP as a bridge asset, You need the token to be priced at a level where it can actually carry that load without catastrophic slippage. This isn't a prediction, it's a design requirement. The math doesn't lie, the system doesn't lie. And when you see the actual institutional moves that are being made right now, it becomes impossible to look at the current price and call it expensive. But math alone doesn't move markets. What moves markets is when the biggest players in the world start acting on that math. And that is exactly what's happening right now. Let me ask you something directly. For months, the XRP community has been asking one question about BlackRock. When is the ETF coming? And I've been saying for a long time, I don't think the ETF is the story. I think the ETF was a distraction. Here is what we actually know. Brad Garlinghouse was asked about BlackRock directly in a Bloomberg interview. His response was careful, measured. He said he thinks it's inevitable, referring to a BlackRock XRP product. But he didn't give details. He didn't confirm anything. And Larry Fink, sitting across from Charlie Gasparino on Fox, didn't bring up XRP either. Two executives, two major interviews, complete strategic silence about each other. Ask yourself, does a $10 trillion asset manager maintain strategic silence about a crypto project unless there's a very specific reason to do so? Matt Hogan dropped something important. He said BlackRock's plan is to tokenize every single product they offer, stocks, bonds, gold, real estate, on a public ledger. Not a private chain, a public ledger, within the next 3 to 12 months. Now here's the theory I'm sitting with. What if the real play was never a spot ETF? What if BlackRock looked at the XRP ledger's design, built specifically for asset tokenization, built specifically for institutional grade settlement, and decided that selecting the XRPL as one of their primary tokenization rails is worth 10 ETFs? A spot ETF gives retail investors exposure to XRP. BlackRock tokenizing real-world assets on the XRP ledger gives institutional capital a home on that ledger. That is an entirely different magnitude of adoption. And the connections run deep. Who is Robbie Mitchnick? He's BlackRock's head of digital assets. And the theory that he was essentially a bridge between Ripple's ecosystem and BlackRock's institutional ambition is not a fringe idea. It is a structural observation. While retail investors are waiting for an announcement, the smart money is already positioning on the infrastructure being built underneath them. A lot of people find this channel right before things start moving. If you're one of them, stay connected. So I want to ask you directly, do you think BlackRock is still in the early stages of their XRP positioning, or do you think they're already deep in? Drop it in the comments. One word is enough. Now let's talk about timing, because this isn't a someday story anymore. The Digital Asset Clarity Act is moving, and what this legislation does is critical. It separates utility from speculation. It creates a legal framework that defines the difference between a security and a commodity, between a speculative token and a functional financial instrument. And the moment that clarity arrives, every institutional player that has been sitting on the sideline, waiting for legal certainty before deploying capital, gets the green light simultaneously. Coach JV put it clearly. Regulatory clarity is the real long-term catalyst, not hype, not a viral tweet, not a celebrity endorsement, legal infrastructure. Because once XRP is formally classified under a clear regulatory framework, the risk premium built into its price disappears overnight. Meanwhile, SWIFT just announced that over 50 banks from across Australia, Bangladesh, and dozens of other countries have signed onto their new cross-border payment framework. Faster, more predictable, more transparent. That sounds like competition, until you read the fine print. SWIFT itself admits that 80% of transaction delays happen outside their network. They don't settle, they message. And no announcement from SWIFT changes that fundamental architectural limitation. Ripple's response to SWIFT? We're not scared. because they understand something the market hasn't priced in yet. Banks don't need to choose between Swift and Ripple. They need Swift for messaging and they need XRP for settlement. The two are not competing. One is the envelope, the other is what actually moves the money. And the tokenization wave, every major financial institution from BlackRock to Fidelity to Franklin Templeton has set targets for tokenizing real-world assets. The industry consensus points to end of 2026 as the inflection point. That runway is shorter than most people in this community realize. But catalysts alone don't explain why the window is shrinking faster than most people think. And that's what I need to show you next. There's a comment I see almost every single day on this channel and across X. It goes like this: I wish I bought when it was at 50 cents. Now I'm paying premium prices. Let me address this directly, because this thinking is costing people their position. There is no premium price right now. There is only the last window before institutional capital closes the door on retail accessibility. Think about the rotation that's already loading. Gold has been pushing historic highs. And historically, every time gold peaks and begins its correction, that capital rotates. It doesn't go to cash and stay there. It moves, and a significant portion of it moves into crypto. We've seen this pattern before. A 2% drop in gold gives XRP a measurable leg up. Now imagine what a 30 or 40% gold correction does to crypto liquidity. That rotation is loading right now. And once institutional money enters at scale, not retail money, institutional money, those tokens do not return to market for a 10% profit. They go into multi-signature cold storage. They go into custodial vaults. They go into tokenization reserves. They are structurally removed from the circulating supply. We are moving from an era of abundance to an era of scarcity. The time traveler framing that was mentioned this week is exactly right. The person holding XRP at 50 cents feels exactly the same way today as the person who will buy at $20 will feel tomorrow. And they're both going to look at $100 XRP in the same rearview mirror because people bought Bitcoin at $60,000 and they'll buy XRP at prices that seem impossible from where we sit today. Because by then, the system will have already confirmed what we're studying right now. The door is closing fast. But I know some of you are feeling the weight of the current market conditions. The red candles are real. The doubt is real. So let's address it directly. Let me be honest with you about the chart situation. One of the most credible technical analysts in this space, 30 years of experience, a chart-first framework that has no ego in it, is showing a structure that most people don't want to hear. He's looking at the weekly close. He wants to see XRP close above 220 on a weekly basis before he considers this a confirmed breakout. Until then, his read is that every pump risks being sell-side liquidity, a mechanism to shake weak hands before the real move. And his model suggests the possibility of a dip below 90 cents before the parabolic move begins. He's not wrong to run that scenario. Historically, the 4-year cycle has been more structurally reliable than the liquidity cycle narratives that others have been pushing. But here's the difference between a technical read and a structural read. Technical analysis tells you where price might go in the short term. Structural analysis tells you where price must go when the system reaches a certain threshold of adoption. And right now, the structural signals, institutional positioning, regulatory architecture, tokenization timelines, ODL volume growth, exchange reserve declines, are all pointing in one direction. Being early feels exactly like being wrong, right up until the moment it doesn't. The red candles are not a contradiction of the thesis. They are the system working exactly as designed. Suppression creates accumulation. Accumulation creates the foundation for a move that cannot be reversed once it begins. I'm trained to distinguish between noise and signal. The noise says, be afraid. The signal says, be patient. And that brings me to the most important thing I want to leave you with today. Something I don't say lightly. Here's the payoff. The debate about Bitcoin versus XRP has always been framed wrong. It's not about which asset wins. It's about what job each asset was designed to do. Bitcoin was designed to exist outside the system. XRP was designed to become the system. Those are not competing visions. They are parallel tracks. and we are reaching the moment in history where the world's financial infrastructure needs the track that was built for it. Rosie Rios doesn't leave the United States treasurer position to go work at Ripple because it's a gamble. Robbie Mitchnick doesn't become BlackRock's head of digital assets and quietly maintain connections to the XRP ecosystem because it's a coincidence. Larry Fink doesn't stay silent about XRP in a public interview unless strategic silence is more valuable than commentary. The plan was always bigger than a spot ETF. The plan was always bigger than a single price cycle. Ripple did not spend billions of dollars building a plug-and-play financial infrastructure stack, winning a landmark legal battle, and signing global banking partnerships to stop at $20. Price is a distraction. Infrastructure is the reality, and the infrastructure is almost complete. History does not reward comfort. It rewards the people who paid attention when the room was still quiet. Now that you've seen the full picture, I want to know, what is the one catalyst you are watching most closely as we move through this year? Drop it below. I read every single comment. If you want this level of structural analysis on every major move, I'll be breaking down the next phase of this in the next video. You know what to do. Stay patient, stay rational. The math doesn't lie, and the system is almost complete.